Well, hello and welcome to Jazz After Dark. How you doing out there? We're going to continue our little Flaviar game here. It's the cool little company that we started kind of ordering from. They send you these little vials of different types of bourbons, whiskeys, gins, alcoholic beverages. You pick what you like there. I will say that this go around, they did not indicate which one is which. So I do not know. They send you these little cards, and I do not know which is which, because normally they put the names. And so this is either the Ikiko 8-year-old sherry cask, or this. Oh, it's this one. It's the Sanin. So sample A is the Sanin. That's what it is called, by Kiryoshi. And there you go. It's pretty cool. So we're going to talk about earnings here tonight while we enjoy a drink. Hope you have a little something to enjoy yourself while you're here. Supposedly, this one's more on the pear flavor kind of a side. If you're curious, it is the Sanin by Kiryoshi, and it is blended Japanese whiskey, pear, oatmeal, and fruit. And I 100% get the pear. That is cool. Dried fruit. Oatmeal, I don't know why that's there. But, oh, hey now. Okay, that's really good. It almost more along the gin lines of things, where you have like a fruity gin. You know, they kind of mess with that. The florals kind of make it taste a little bit more fruity. That's the best Japanese whiskey we've had here so far. That was a lot better than the one the other night. I would give that one like a B. I don't know. What was that, like an 80? 8. Let's say 85 on that one. No, because Buffalo Trace 86 for me. For Japanese whiskeys, it's an 85. Otherwise, this not my favorite for general. I think that Maker's Mark the other night was better. All right, I promised we would talk about earnings. Damn, actually, it's growing on me. It's really growing on me. We've got the first quarter earnings season coming up here, and we are a little different breed of financial advisors. We literally track everything between using our own internal software, AI, you name it. We can track everything. And of course, we have a lot of assistants that we use Goldman Sachs as our custodian. So our clients have access to literally everything that they do. I had a client selling 2 grocery stores, like a chain, a very small chain. And I didn't know how to handle that, but turns out they have a mergers and acquisitions specialist department that I was able to put them in touch with, and they got a team of people to help them sell this grocery store. It was pretty cool. I got to be a part of it, but naturally I was, a fly on the wall essentially. But anyways, we like to track everything here because we manage our own funds. We make decisions on those funds. Our clients are very happy with the performance of those funds. Thankfully, if they weren't, of course, you would see that plastered around the internet. But I've been pretty happy too, just how we've been, navigating the market, having a little bit more cash over the past couple years, in and out a little bit, but we're not active traders. Nonetheless, we have first quarter earnings season coming up, and it's going to be an interesting one. This is, every earnings season is interesting, but starting next week, we get the big banks. And that makes it interesting in itself. You got BlackRock, JP Morgan, Citigroup. Those guys kind of get us going. Then the small banks get us going there. And if you look in the S&P, if you go to, what's today? So today's the 6th. Actually, so within a month, we'll have almost 90% of the S&P reporting. So that shows you how fast these things kind of come out there. General earnings expectations is for the S&P as a whole to see earnings fall by 7%. And that's not a stock specific thing. When they say S&P earnings are down 7%, that means as a whole, every stock, all 505 positions that are in there, granted, some of them are just different classes of stock, but the index as a whole, after reporting, will have found that those companies lost about 7% in earnings there. That will be, if that pans out that way, about the worst since we were in kind of the thick of COVID, early parts of COVID there in 2020. And so we naturally, a lot of earnings were dropping off at that point there. So we will see how that goes. Now, before I get starting some of this here, because there's a lot of good news wrapped in this earnings as well, Materials and healthcare are expected to see their earnings drop the most. I might have that on a slide here, so let's just dive into that. The first thing I want to talk about, well, two things. The first one is, remember, there was a new reclassification of some stocks and the different industries that they represent. So if you're used to tracking along sector by sector earnings or just following along there, well, keep in mind that, for example, Target is no longer a consumer discretionary stock. So it was in this sector over here. This will be the first time that it counts and helps or assists the consumer staples sector. So a little switcheroo there. And we did a Jazz After Dark on that, so you know all the different changes there. Visa, MasterCard, PayPal, all making changes. And so really, really kind of interesting. Let's get started here. The good news is we are looking at the S&P potentially losing 7% in total earnings there. However, that's going to be considered the trough. So there's a couple interesting things that really don't make the headlines here. First of all, this could be reported as very bad news. The S&P earnings dropped 7%. Yeah, but we expected that. Anything better than a drop of 7% is great news. Because number one, it's not as bad as we feared. Number two, that is predicted to be the trough. So here's quarter one, which we'll be reporting here now, then two, and so on and so on. As far as the earnings pullback goes in the market, this is as bad as it's supposed to get. And so what's happened here is they've essentially set the bar really low. And I'll show you here in just a second. They kind of tricked the system a little bit. They do this. It's very normal, and I'll show you. But before we do that, I'm getting excited. I'm talking fast and stuff. We're talking stocks. Margins, going to be one of the major focuses. Here's the prediction and the history, just so you have that. We take out financials and utilities when we talk about S&P's net margins there. And so we look for a forecast. This is not my guesstimate. This is the average analyst estimate of 10.4% total net margins. Visually, if you don't know what's going on visually, it will be a pullback, but still very strong. Total net margins of S&P companies have done really well. They've had their COVID pullbacks, their recession pullbacks, their dot-com pullbacks. But all in all, net margins are still very, very strong. Now you're going to find that margins are weaker in energy. It's not, whatever side you land on, it's not a favorable environment for production of oil. Now, there could still be bets and oil exportation and stuff like that. But sadly, in the States, oil production is kind of like frozen with the current administration. That could change, but that's where it stands now. Okay, now here's the fun part. They set the bar really low. I tried to think about how do I visualize this here? I'm trying some different things on you guys lately. So it is very normal for the early part of the year for them to reduce earnings expectations. I got a really good visual in a second, but analysts that cover the S&P and all the stocks involved in them, there's a whole bunch of them. And what we do is we say, what do you guys think is going to happen? And as much as they get picked on, these are the smartest guys with these stocks because they have inside information. See, they're allowed to go, they have analyst day at each one of these public companies. And the analysts that cover the stocks will either go or they will be on a conference call and get to ask questions that me and you don't know how to ask because we don't study them enough. They get to ask questions and the CEOs, the CFOs, they answer those questions. Now, in order for it to not count as inside information, they put that in their analyst reports and they say, based on what we found out, this is what we think will happen. They crunch the numbers and do all that stuff, run their models, and that's where it's at. Now, analysts have gotten smart over the years, and this doesn't always work, but what they do is they lower their expectations around that Q1. And so I'll show you here in just a second, but this is just to illustrate the average expectation is for about 12% growth. I think it's about 11% now, actually, over the last couple of days. We are well below history. So in other words, if you look at all the S&P companies, they're basically telling Wall Street, we're going to do this. We should land somewhere in here. We're not sure, but we should land in here. And analysts have said, We believe you, but we don't believe you. We think you're going to do this. And normally they set the bar a little bit low anyways, because companies want to put their best foot forward and analysts want to put the most pessimistic view forward because they want to get it right, and the company wants to get it right. They want to come out better, looking better. And so what analysts have done is that this time of year they go, we were going to go here. We're going to be a little bit more negative. And this time's a little different because supposedly the economy is weakening and all of that stuff. But to prove it to you, year over year, just learned how to do this on a chart. So year over year, here is analyst projections both for the year and going forward. So for example, 2016, this was their forward expectations, 2016 expectations, and then we would have been in 2016 when they made their first quarter 2017 projection. Right? So then there's this overlap. We had 2017 projections ahead of time and then during, as well as looking a quarter forward. What do you notice about this? Do you notice that projections start strong and fade, start strong, fade, start strong, faded? But I'll give you that. Start strong, fade, started with just being strong and then fading away. Same. 2022 is the only time. Remember the big influx, or what was the word that they used? Pent-up demand, right? That was the expansion of that pent-up demand. That was kind of once in a lifetime, we hope, anyways, after COVID. Well, what do we have for 2023? Expectations last year started strong. Yeah, naturally, the Fed's been raising rates more than expected, and the economy showing little signs of cracking here and there, and companies are boosting themselves up for a possible recession. And so estimates came down. This time, it's coincidental that it makes sense for analysts to lower their expectations. Whereas normally they just kind of do it, and we're like, what? Companies are going to do better. Now, what does that mean from like an investment side of things? It means that the market is setting itself up for any pullback to be buyable. Why is that? Because think about what happens here. We go back to this scenario. Estimates are set really, really low, and we're predicting it's the trough, and we're predicting that the Fed is nearing the end of Fed rate hikes. We have all that lining up together for obviously good support in the market. But when you put those pieces together, you go, so I welcome a pullback. I welcome a decline in the market, some temporary panic or whatever. That's fine, profit taking, if you will. However, we know now that the big investment company, they're going to look at that and say, this is a buyable pullback. The market becomes undervalued, under 18 times earnings, right, for the S&P. It becomes undervalued in a scenario where there's all these things lining up that say, that's a discount, one after another. And I've been trying to point them out on the closing beat, point them out here and stuff. And so you now have that mindset of, well, I know what they're going to do. They're going to use weakness to load up positions, to put cash to work, to buy discounts, to buy temporarily beaten down stocks that had maybe a slight miss on earnings, or it wasn't, as bad as thought. Really, really cool. However, there's a little bit of bad news. The bad news would be if you're in like a small cap fund, in your 401k, TSP, whatever your 403bs, if you have a small cap fund and you look inside of that or do some research on that small cap fund and you find out that it's 21% financials, 30% financials, that would be a lot actually. Let's go back a step. 21% financials, 18% financials, something heavy in financials. Where'd we start? It's called a small cap fund, but its allocation is double digits to the financials. That means that I'm in those small cap financial stocks. That's not looking good for them. Remember, they're the banks that are going or potentially have been having issues. If we look at the analyst expectations of that, since if we go year to date up to or since March 8th, no, over here, I put it over here. So if we go year to date, the blue is the dark blue is the S&P. The blue is the Russell 2000 financial sector, not the Russell 2000. The Russell 2000 financial sector. I didn't put this clearly here. So obviously there's a slight decline in the S&P. We're expecting a little bit less in terms of earnings, but the Russell 2000 small caps year to date, Very, very bad. Another 3% is my bad. I should have flip-flopped these. Another 3% has come off of that since this banking, you know, whatever they end up calling it, the banking panic, or I don't know. But since that started, they're no dummies. They're saying, okay, well, we're going to find out because earnings are coming up. But the big banks seem to have absorbed a lot of that money and even absorbed some of the banks. But the big banks now are probably fine. Their margins are actually going to come in higher than expected. Mark my words on that one. And so small cap banks, unfortunately, they're the ones struggling. They see the withdrawals coming out. And so their earnings on what they call net interest income is going to be a lot lower. It's just less cash. People move their money, not maybe they panicked, maybe they went to bond funds or something like that. I don't know. But that money's coming out. So if you're in small cap financials, it could be a wild ride there, in all honesty. So there's a really fast way of going through a whole bunch that we could really just, each one of those slides we could spend time on, but we don't have that kind of time. What I'll do probably here is, as I get more comfortable with this, all this stuff, I'm at home. This is my house. So I have the one thing on the wall, and my wife was like, it still needs to look good. It can't just be stuff everywhere. So once I get comfortable with what she's allowed me to put on the wall, I'll probably do a live version of this, and I'll probably just make it live so that we can kind of go in detail and I can gauge what you guys are like. Whoa, Dustin, stop. You said something. Let's go back to that. I don't know what you said, because otherwise I just ramble and talk to the camera, and the camera's not like going, or, so I don't know if you like or don't like stuff. I just do what I do. The point of the story is, here comes a sales pitch. Is your financial advisor doing this? Or if you don't have a financial advisor, are you doing this? Are you doing any kind of research? Are you getting any kind of help? It becomes really important year after year that you fine tune this stuff, right? Have an understanding, or have someone who has an understanding of how this all works. I love it. I'm not doing anything else. We all love it here at Jazz. And we're all also thankful that you're watching. If we are not a good fit, or you go, I'm not sure if I need a financial advisor, I'm just happy that you're watching. It's fine with me. YouTube will pay us a few bucks. We'll keep the lights on. I'll be happy. But I do appreciate you guys watching tonight. I will go enjoy the rest of this. Again, Kiriyoshi by the Sonin. And it's not bad. If you like pear, you're going to love this. If you like that fruity pear, very light kind of whiskey in there, but not spicy at all, you'll love it. Not my favorite, but we'll be back tomorrow. Enjoy, and thanks for watching. If you learned something, at least hit the subscribe button, right? That's like your way of making a donation, right? So I appreciate that if you'll do that, if you're still around and watching. If not, well, just talking to myself. So I'll get out of the way.